Professional options traders are acutely aware of opportunities that arise out of major news events that can move the whole market, like the upcoming presidential election in less than 3 weeks. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the professional traders on our desk are experienced with how to turn predictable changes in the options market into trading profits because of their experience and education. In this video, we're going to be showing you a vivid example of an options strategy that's remarkably effective around presidential elections. So stick around because I think you're going to find this pretty intriguing. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so I'm pretty sure that you know we've got a historic, monumental election coming up in less than 3 weeks, and you may also know that presidential elections are regarded as a major event that can change public policy so much that the market expects a large move right around the election, depending upon how the election turns out. And there are option strategies that are designed to take advantage of this volatility, and that's what this video is about. So the key to understanding this strategy is to understand an options concept known as implied volatility. And we're going to explain this strategy in terms of how it can be deployed with index options. So we need to do a very quick review of index options to make sure you understand how they work, and then we'll jump right back into the core concepts of the strategy. So now almost all of you are probably familiar with equity options, where a call buys you the right to buy 100 shares of a stock at the strike price of that option anytime before the option expires, and a put option entitles you to sell 100 shares at the strike price of the put before that option expires. But there are also index options, which work similarly to equity options, except there's no such thing as 100 shares of an index like the S&P 500. You can't really buy or sell 100 shares of an index, but what you can do is get paid in cash, $100 per point if the index expires above the strike price of an index call that you buy, or alternatively, you'd be paid $100 per point for each point the index drops below the strike price of your index put. So for example, SPX index is trading at 33.50 and you buy the 33.60 call. If the index closes at 33.65, you'd receive $500 in cash in your account. If the index closes at 33.60 or lower, on the other hand, your call expires worthless. On the other side of the market, if you buy 33.35 put and the market sells off to 33.25, you'd make $1,000. But if the market just sold off to 33.35 or higher, the put would actually expire worthless. So those are the basics of index options. And remember, you can buy options, but your broker will also allow you to sell options as well. And your broker will also allow you to put together combinations of options, in other words, option strategies that involve both short and long options purchased in a way that's advantageous to you as a trader. Okay, so now that you understand that index options are settled in cash, then you should be able to understand that people selling those options have to make sure that they'll collect enough cash originally when they sell that option to cover what they think will be the move that the index will make before that option expires. If they don't collect enough cash to cover that move, then they obviously will lose money. So if they don't expect much of a move, then they'll charge less for that option. And if they expect a huge move, they're most likely going to charge a huge amount for that option. So the concept of what options traders call implied volatility is a way of kind of measuring the amount of movement that the market is expecting the index to make as it relates to the option that's being traded. This concept will get more clear as we move into a specific example, so let's just jump into that. So the last presidential election, of course, took place in 2016, and so let's take a look back at the months leading up to that election, which was on November 8th, 2016. And as you can see, the SPX index was channeling between 2100 and 2200 for the entire third quarter of 2016, July through September. And so a trader could well have developed the thesis that the market was going to continue channeling in that tight range until the election was resolved, at which time it will either break up or break down from that range. So let's take a look at what would have happened if the trader were to have entered into what options traders call a double calendar trade on October 3rd, about a month before the election. So he strategically places his trades such that the short options expire before the election and his long options expire after the election. That was intentional because if the SPX stays in that range that it's been in for 3 months, right up until the election, as the trader is speculating, then think about what would happen. The short options both expire worthless because the calls are located above the upside resistance price and the puts are located below the downside support level, which has emerged in the third quarter. Now, why is that significant? Well, if the market stays between those two prices right up to the election date, then both of those short options will have no value. Why? Because if the market is still above 2100 before the election, then the short put will have no value when it expires because remember, puts only pay off if the market is below the strike price of that put. Similarly, the call only has value if the market's above that call strike price on expiration day. And so if the market stays in that 2100 to 2200 price range, then the call also will expire worthless. Well, we're short those options, meaning we're the ones that sold them. And so we are the ones who have to pay off if the market is above the calls or below the puts. And so therefore, we actually want them to expire worthless so that we can just pocket the premium we received for selling them. And so that is why we sold the calls and the puts where we did. Now, you'll also notice that we bought the call and put options in the week right after the options expired, and that was quite intentional as well. You see, remember, we were talking about that principle called implied volatility before. Well, the theory of this trade states that as the election approaches, options which expire after the election takes place will become increasingly pumped up with pricing by the market makers who sell those options so that they can make sure that they get paid enough money so that even if there is an explosive move in the market that would affect that option, the market maker still has a decent chance of making money on that option. Well, if an explosive move is possible, then the market maker will have to load a lot of premium into that option. And so that extra options premium that gets pumped into options prices is what I mentioned earlier is measured by options traders through a calculation called implied volatility of an option. And you can see from this options chain that the implied volatility of the calls is 10.9% and the implied volatility of the puts is 15.9%. So while we're not going to be getting into the exact mathematical details of how implied volatility is calculated in this video, let's just say that if the options market thinks that the stock market will be calm before that options chain expires, the implied volatility of that options chain is going to be low. Whereas if the market believes there will be a big move before those options expire, exposing them to a large payoff in one direction or the other, then the implied volatility of those options will be high. Now, before we get into how this trade plays out and what happens to the value of the different options as time passes, I wanted to let you know that beyond what we're teaching you in this video, there are a large number of sound, viable long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use all the time, including a really simple but incredibly effective strategy that some of the greatest investors in the world, like Warren Buffett, use constantly, plus an option strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with the stock that you like, where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. And so if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open up a free registration page in a new window, so don't worry, you won't lose this video. You can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. Now, before we get into what happens with this trade as it approaches the election, let's first look at the cash flow implications of what has happened upon trade entry. So you can see that the 2,200 calls that expire after the election, those calls that we're buying, they go for $14.18, but remember they represent $100 per point above the price of 2,200. So that's multiplied by 100, and we bought 10 of them. So we multiply everything by 10, and so the total cost of those are $14,180, as you can see. With that same logic, those after the election 2,100 puts cost us $21,350, and then of course remember we sold the options that expire before the election. The 2,200 short calls and the 2,100 short puts, and having sold 10 of each of these at those prices, you can see that because we sold them, we received those amounts for having sold those options. And so when you net out what we received from the short options from what we paid for the longer dated long options, the net cost to us was $11,300, which is the risk that you have on this trade, by the way. Now let's move to Tuesday, November 1st, 1 week before the election. And as you can see with pre-election jitters, the market's actually sold off down to 2108. So let's break down what's happening here. First of all, on the call side, you can see that the short call, which is about to expire on November 4th, that one up at 2,200, that one has almost no value, and that's going to expire in 3 days, and the market's way below its strike price, so that makes sense. The long option, which expires the next week on November 11th, that long call, well, that one has lost most of its value, but the election is coming up, and in this case, with 10 days to go, it still has a little value because there's a potential for the market to hit that level. Now, the put side is really interesting. As you can see, the short put is worth $10.38, which is less than we sold it for. So we're actually up a lot of money on that one, because when you're short an option, you want its value to go down, obviously. So even though the market is so much closer to that put, it's actually dropped in value because these options only have 3 days left. And then the long puts expiring after the election, well, those have really gone up nicely at an increase of $8, because the election is right around the corner and the market has moved much closer to its strike price as well. But unlike the short put, it's going to expire after the election, so the option must retain that really pumped up premium. In other words, its implied volatility has increased significantly, which was the whole idea behind this trade in the first place. And so if you take a look at the scorecard on the trade at this point, you'll see that the value of the long options minus what it would take us to buy back the short options is now $19,600. And the trade was entered for a cost of $11,300 for profit, unrealized of course, so far at $8,600. Okay, so now let's move to November 4th, now just 4 days before the election. And it's actually also the same day that those trades expire. And you can see that the pre-election anxiety has driven the SPX index down to 2085.20, where it closed that day. Now, traditionally, the latest that you would close a trade like this would be the day the short options expire. And so at this point, we can take stock of what has happened because we're going to be closing the trade. And so the short call at 2,200, well, that's going to expire with no value as it's way above the market price. And the long call, expiring in a week, also has lost most of its value because it's only got a week to go, and that may not be enough time for the market to rally after the election up to that $2,200 level. Now, what's really interesting is looking at the put side. You see, the short put will be settled at $14.80 because the strike price is $14.80 higher than the index expired. In other words, the option has expired in what options traders call in the money. So we owe the owner of that put $14,800, but don't forget that owner paid you $15,030 for that option. Even though you owe him money on that put, you still made money from that option because you collected more than you paid out. And finally, the long put expiring after the election, well, that has nearly doubled in value and is now hugely valuable because the election hasn't even taken place and the XPX is already trading below that put option strike price, which means it's incredibly valuable already. And so if we do a final result of the trade, taking the amount that we receive from selling the long options expiring in a week and the cost of settling those short options, which in this case was really just the settling of that 2100 put, if you add it all together, you'll see it was a tremendously successful trade with a profit of $13,400 on an original investment of 11.3, which is a 118% return in about a month. Not too shabby. And so what I'd like you to take away from today's video is that professional options traders are familiar with the nuances of changes in implied volatility and how to leverage those changes with option strategies like the double calendar. This same principle can be applied to options on individual stocks about to make a major announcement and in lots of other scenarios as well across the spectrum of assets traded with options. By having a sound foundation of knowledge about options trading, you can apply your knowledge to lots of different market situations and set yourself up for trading profits in many different ways. Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it, and you'd like to learn the real-world details of option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That's going to open the free registration page in a new window, so you won't lose this video, don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss all of the free trading videos that we're posting constantly on our channel to help you to improve your game as a trader.